In this Patreon requested video, we're going to take a look at some higher yielding dividend investments that are more tax efficient. Because a lot of people I understand like the idea of pursuing higher dividend paying investments outside of a retirement account so they can access the dividends earlier in life, but the taxes are always the biggest downside to doing this. So today we're going to look at some options that exist that still offer higher than average dividend yields and come with either lower tax rates or even tax-free distributions. And just to throw this out there, I'm not a tax expert and you should seek a tax professional before making any decision when it comes to tax strategies. We'll start by looking at some individual stocks that offer qualified dividends. When you receive dividends from the typical stock or ETF, the money you get is either classified as qualified or non-qualified. Sometimes non-qualified dividends are also referred to as ordinary income, which is because these dividends are taxed at your current income tax rate. Qualified dividends, on the other hand, are taxed at a lower tax rate than non-qualified dividends, which can save you a good amount on your taxes. The downside to qualified dividend-paying investments is that they offer significantly lower yields. If we compare popular qualified dividend stocks with non-qualified dividend investments, you'll notice that although you are going to be saving money on taxes, you're not really earning that much in dividends. Stocks like Sherwin-Williams, Colgate, and Procter & Gamble only yield around 1 to 3% on average, and as of 2 months ago, the average yield of an S&P 500 stock was only 1.35%. But there are a handful of options that do exist that do offer higher than average yields than this. Despite a challenging environment, one company that's still paying a very well-covered and growing dividend is Altria, ticker MO. The stock has grown its dividend 58 times in the last 54 years, which includes a sizable 4.3% increase last August. This company's main products include cigarettes and other tobacco products, but they have been branching out into wine and pod and other categories in the last few years. So far, they haven't made anything that's been able to compare in popularity to their cigarettes, but given this company's financials, they still have the power to keep sustaining their dividend for many years in the future. And with a dividend yield of over 8.5% that's also qualified, it's hard to beat a dividend-paying stock like Altria in this area. One sector that does pay good qualified dividends would be the energy sector, and there's a few companies out there that are offering decent yields with good growth. For example, ONEOK, ticker OKE, is a company that engages in the gathering, processing, storage, and transportation of natural gas in the United States. This company owns natural gas gathering pipelines and processing plants in the Mid-Continental and Rocky Mountain regions. The stock currently yields around 5%, and although they haven't increased it every year, they haven't cut their dividend in over 25 years. You can see their share price at times has fluctuated pretty severely due to energy prices, which is something that's going to be normal in this sector. But this company has continued to do very well. Two other energy companies with higher than average yields and long-term track records of dividend growth would include both Chevron and Exxon. Both companies are dividend aristocrats and are both pretty solid investments, although I do prefer Chevron for its better dividend growth and higher dividend yield. Another stock that I've never mentioned that is offering a higher yield and appears to be pretty healthy for the time being is T. Rowe Price, ticker TROW. This company is also a dividend aristocrat and is currently one of the highest yielding aristocrats out there. Switching gears now, there are some closed-end funds that offer dividends that are more tax-friendly and that they're classified as long-term capital gains. Within this field, there are a number of different funds out there that have their own unique strategies, so you want to do your own research when you come across one that sounds interesting. A lot of these funds will hold a majority or only dividend-paying investments, both common and preferred stocks, and what happens is the fund managers will regularly sell holdings in these funds to cover the dividends, and the dividends will be classified ideally as long-term capital gains. Dividends that are from long-term capital gains are taxed more efficiently than dividends that are classified as short-term capital gains or income. Some more good news is that these funds can offer yields of over 7% or higher, and they typically do pay monthly dividends. These brackets are from last year, so the amounts are going to be different this year. But you can see that if the dividends paid by these CEFs are classified as long-term capital gains, that means a lot of your dividends are actually going to be tax-free from these funds that follow this strategy. The bad news is that because there's so much activity with these fund managers buying and selling in the funds, that they do typically charge very high expense ratios. For example, the John Hancock Tax Advantage Dividend Income Fund, ticker HTD, charges a 4.24% expense ratio. Another bad thing is that their dividends typically move with the market. This ETF, for example, holds utilities, which are still largely down. This both negatively affects its share price and the dividends can vary depending on the market. However, it might be worth considering one of these ETFs if you're okay with a high expense ratio. If they pay a high monthly dividend and it saves you a lot in taxes, I personally could see that as a worthy consideration for someone. Another company by the name of Eaton Vance also has a lot of these tax-advantaged ETFs with funds that target US equities and global companies. Like I said though, each of these have their own unique strategies in terms of what they invest in and the kind of tax strategy that they have, so do your research before considering one of these investments. Some that are worthy of consideration would be ETG, which is the Eaton Vance Tax Advantage Global Dividend Income ETF, EVT, the Eaton Vance Tax Advantage Dividend Income Fund, and also HTD, which we looked at earlier. These funds offer yields around 7 to 8% and they all pay monthly dividends. I should probably take this time to answer the question I'm sure a lot of people are asking, which is how do you know the dividend tax treatment of a stock or an ETF? With a stock, you can either try to find a 1099 DIV form on the investor relations section of their website. If you can't find one, you can also go to dividend.com and look up a dividend stock. If you scroll down under payout history, it'll show if a dividend is qualified or not. For an ETF or a closed-end fund, you want to read the prospectus to see if investors can expect the dividends to be qualified or ordinary income. Another option that exists, depending on which state you live in, are municipal closed-end funds. These investments hold securities that are exempt from federal and state income taxes, such as schools and utility muni bonds. Because these bonds don't typically offer attractive yields, they usually employ a lot of leverage. But fortunately, these are municipals, which aren't risk-free, but they're very low risk compared to other investments. While most of these investments don't see a lot of share price action, they are interest rate sensitive, and many of them are still heavily discounted with interest rates being so high. There's two major fund companies that issue these state-specific muni CEFs, which are PIMCO and Naveen. As I mentioned earlier, they don't have funds for every state. PIMCO currently has only 2 state-specific funds, which are for California and New York. Naveen, on the other hand, has 9 state funds, including a fund for Arizona, Massachusetts, New York, and a couple more according to their website. These funds typically yield around 4 to 5% on the low end, which isn't great, but it might be worth considering if you are looking for more tax efficiency in your dividend portfolio. They do pay monthly dividends, which is also a huge plus. If there isn't a fund that exists for your specific state, you might have another option, although I would recommend talking to a tax specialist before making an investment. These fund companies do have broader municipal funds that hold munis from a lot of different states. It's possible you might get a portion of the dividends tax-free depending on how much of the fund's holdings come from your state. For example, with the Naveen Select tax-free income portfolio, some of this fund is made up of Idaho munis, so it's possible you won't have to pay taxes on the percentage of your dividends that come from Idaho munis if you're in Idaho. I've personally never done this myself, so I would suggest talking to a tax specialist before considering this. And that's going to wrap up our look at some of the most popular tax-friendly investment types for income investors. There are some one-off company stocks that have more tax-advantaged dividends, but I only wanted to cover the broader categories in this video. Sadly, there are no tax-advantaged dividend-paying investments to my knowledge that yield over 9 or 10%. Right around 7 to maybe 8% is around as high as it comes for a tax-advantaged ETF, unless someday a company's able to introduce something. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.